Stocks are sharply lower, with financials and realty being the big drags, even as consumer durables and utilities see some green.
Novelis announces its IPO pricing of $18 to $21 per share, implying an equity valuation of near $11 to $12.5 billion. This tops most analyst estimates and is a positive for Hindalco.
Sources tell CNBC-TV18 that Paytm boss Vijay Shekhar Sharma may be engaging with prospective investors for them to buy a slice in the payments player. The talks are likely at an exploratory stage. Both Paytm and Adani have denied any deal talks.
Crude scales to a 4-week high on U.S. summer demand, rising tension in the Middle East and lower OPEC crude exports. The market remains on edge ahead of the OPEC plus June 2nd meeting.
Good afternoon. You're watching us here on Halftime Report. I'm Manglam Malu. Today with me is Sonia Shenoy. There's some profit taking in the market, maybe a little bit of nervousness ahead of the big events that are lined up over the next few trading sessions. Sonia, down but not quite out, right, after the rally that we've seen?
Absolutely. You know, we were having a chat with Sudarshan Sukhani earlier in the morning, and he said that generally, I mean, he's seen so many cycles, right? Totally. Generally during election time, the market tends to get jittery, and it's nothing to worry about. If anything, if you're bullish on the market post-elections, then you should use this as an opportunity to buy. But that's his view. But for now, it seems like that, right? I mean, it's really par for the course, the kind of fall that we've seen. Given the kind of run-up from the 9th of May, this is not a bad outcome at all. And in fact, the mid-cap index is actually outperforming the rest of the universe. So that just goes to show that a lot of stocks, which are market favorite stocks, right, are looking pretty good. So case in point, there's Campus Active, Nalco, Hoodco, Hindalco, NBCC, PNB, Zomato as well. All these stocks are sitting at with green on the screen despite a market that's falling, so not bad at all. Not bad at all.
In fact, talking about the mid-caps itself, you know, something like an AB Fashion, their EBITDA grew by about 47%, the revenues grew by about 19.5%. The street initially took note of the management commentary on weakness in demand, and the stock opened lower after having entered F&O ban as well. From there has been a recovery, so all dips are being bought in a lot of these mid-caps. Something like a Jubilant Foodworks as well. You pointed out Zomato. Jubilant Foodworks is up around 11% in this week itself. So a lot of the broader market stocks are actually finding some favor at current valuations. So let's speak about some of these broader market stocks itself. Greenlam Industries is the first management on the show today. The company reported a revenue growth of almost 17% and EBITDA growth of nearly 12.8% as well, implying margins of around 13.5%. Remember, the earlier guidance of the company for growth was around 20-25%. Let's see what the company has to guide for now for the next year itself. Saurabh Mittal, who's the MD and CEO of the company, now joins in. Thanks a lot, Saurabh, for joining in. You know, that's really the first question. You had earlier guided for 20% in FY24. Obviously, because of the challenges, you fell short at around 14%. Right. You had a target of 20-25% growth in FY25. So would you stick to that right now? And what would your margin estimate for the next year be?
Right. So FY25, we should be looking at about a 20% plus minus growth, you know, for this year, considering the new capacities which came on stream in FY24. So yes, it should be in that range, I guess, unless something comes up. Yeah, we should be able to grow about 20% in this financial year.
Okay, 20% in FY25 is the kind of growth that you're looking at. You know, I just want to understand a little more about how business is shaping up in terms of demand, because, you know, this is a space that is growing very rapidly. But in this entire space, right, whether it is laminates, decorative veneers and all that you do, plywood, etc., where are you seeing maximum scope now over the next, say, 12 to 18 months? And what kind of growth rates are you seeing in individual verticals?
Well, hard to give you, you know, individual growth rates, but I think we'll grow across all the categories and segments we're present in, whether it's laminates, domestic, laminates, exports, the decorative veneer, flooring top business. The plywood business is relatively new to us, so we'll grow there too. We'll be starting a particle board plant sometime in Q3. So I think that'll also add to some revenues. So we see growth happening across categories, across geographies. On the demand side, you know, while you say, you know, it's growing very fast, but on ground, the domestic demand has been challenging. And even the export demand has been challenging, you know, backed with a large shipment problem to the western part of the world due to the Red Sea. But having said that, we still have been able to, you know, grow the business well, I would say, in Q4 and last financial year. Yeah, for this year.
Let's get a little more. Yeah, go ahead.
No, for this year, we'll expect growth across categories.
Growth across categories. So let's get a little more specific, because realizations the full year were largely flat in the laminates business. We saw a decline of 0.6%. In veneers, there was an increase of around 1.4% in realization. So what is the sort of volume and realizations that you're gunning for in both these segments in the next financial year? And you briefly spoke about domestic and exports as well. So what's the mix that you're targeting this year?
Correct. So FY24 volumes, I think we grew, double digit across all the categories: laminates, veneer, flooring, doors. Ply was a new category, so not much benchmark. So I think we grew double digit across all categories. And on the realization front, despite again the challenges and the volume increase, I think we've had a lot of pricing discipline. We improved value mix, so you don't see much, reduction on the price realizations across categories again. FY25 too, I think we should be growing. I think volume terms double digits across all the categories.
Okay. So as this growth comes along for the business, right, what are we looking at in terms of debt? Do you think you may have to take on more debt, over and above what you're already sitting on? And what's the absolute debt right now?
So net debt, FY24 was about 835 crores approximately. And FY25, that might go up a little bit because we have to complete the capital expenditure and the plant at the Andhra Pradesh for the particle board. In FY24, we started 2 greenfield projects and we did an expansion at the plant we had acquired in Gujarat. So we had, so we had a significant amount of capitalization happening in FY24. FY25 will start the greenfield plant of particle boards in Andhra Pradesh. So that might go up a bit this year, post which we see, a reduction happening in the debt.
So what are you comfortable with in terms of the maximum debt equity ratio? What is the comfort zone now?
So we are okay at the position we are in right now. It's like 0.75 or 0.8 debt equity. So we're okay with this. And some of these projects, are high capital expenditure projects, especially the particle board business. And even the laminate business, we built a larger plant because if you see the quantity growth programs plan we have, we'll again need to expand, hopefully, in FY26. So yes, so we're okay with where we are. Once these projects come to stream, we'll have reduction in debt happening.
All right. So let's talk about these projects coming into stream and increasing their utilization as well. So it's a two-part question here. One, earlier, you said that at peak utilization, the revenue potential for all of this could be around 3,000 to 3,500 crores. And there is a delay and a cost overrun in your particle board project in Andhra Pradesh. You've increased your capacity or announced an increase in capacity along with an increase in cost as well. So what does that mean in terms of incremental revenues? This 3,000, 3,500 crores which was there, where does that restated number stand at? And by when do you reach it?
So we had said, I think, if I remember correctly, 35 to 100 to 3,600 crores on a near full capacity of the investments we have done. And now with the expanded capacity or additional capacity of particle boards and some other, gradual improvements in price mix, that number looks to be about 4,000 odd crores, of the investments we've done and will complete in FY25, which probably will happen maybe by FY, 28 maybe, so we at 25. So about 3 to 4 years, we should be, in that space.
And by then, what would the margins look like?
Well, so if you see the numbers of FY24, we've have elevated costs of manpower, marketing, 2 new plants have got capitalized as high interest and depreciation costs. So clearly, if you achieve those volumes, we should see improvements in margins across categories.
In the residential segment, just wanted to understand, has the growth picked up a lot across maybe this decorative veneer segment, the engineered doors and frame segment? I'm asking because, there is this big boom that we're seeing in real estate right now, but has that even translated to businesses like yours? And if yes, could you help us just quantify what the demand and the growth has been in the residential space over the last 1 year?
Right. So we do think that there should be a big demand happening, in the residential space. We haven't seen that as yet. When I speak to our customers, our teams, and with understanding, the sense I get is that a lot of this construction which has happened, projects which have been announced or which is happening will come for interior fit outs maybe 9 to 12 months from now, or maybe H2 of this year. So yes, if you take a next 2 to 3 year, 4 year view, things look attractive because so much of construction and residences have happened through the country, are happening, and all these apartments, homes will need interior products, and all the categories we're present in. It kind of has a demand, has a space, in these homes. So whether it's doors, flooring, veneer, laminates, facade laminates. So yes, as we talk right now, we haven't seen that surge in demand yet. I think we're still struggling to win more market share, but I think moving ahead, we probably should see better demand coming in.
Quickly leave us with just two numbers. One, veneers, you were speaking about profitability that has happened. You've broken even. By when do veneer margins go, in line with what your overall margins are? That's point number one. And secondly, plywood capacity utilization was 14%. You're scaling that business up.
Right.
What does that capacity utilization be at this year? So capacity utilization of plywood and veneer margins.
So capacity utilization of ply should improve. We're present in only one part of the country, and we launched the product in June 23. So we should see improvement happening, Q and Q in the plywood business. Veneer flooring doors, we have become EBITDA positive, and we should see improvements happening there too. And in fact, even the new laminate factory we started in September 23 has become EBITDA positive in Q4. So I think across segments, across manufacturing units, we should keep seeing improvement, I think, as we move ahead. Can't give an absolute number or a timeline to you, but clearly I think there should be improvement happening.
Okay, well, that we leave it at that. Thanks a lot for joining in, and all the best for the future. We'll slip into a quick break. On the other side, we'll get more on the markets. But before that, a small programming note for our viewers. Join us live on the 31st of May from 5:30 onwards for CNBC TV18's Future Female Forward, the Leadership Circle, a transformative platform where leaders from diverse fields will venture beyond the traditional discourse and share stories of grit and determination and the roads less traveled. This Leadership Circle is not just about business strategies and professional accolades. It's about delving into the depths of the personal journeys of these trailblazers. Stay tuned. Welcome back to Halftime Report. Now, Monte Carlo Fashions is the next management of the show. The stock is under pressure after reporting a weak set of numbers. The revenues went down almost 13% year on year. Factors such as higher returns and discounts resulted in the decline in margins. To discuss this, we have Sandeep Jain, the Executive Director of Monte Carlo Fashions, joining in now. Sandeep, thanks a lot for joining in. First, I want to talk a little bit about that because discounting has been on the higher side. That has resulted in a decline in margins. Do you think that there could be more pressure on the operating performance? Could it get worse before it gets better?
Yeah, I think the worst is behind us. The reason being is that, we had very two good years starting from 2021 to 23. We had a CAGR of around 35%. So what happened was, there was a good trade show. So we planned more merchandise also, but the season, the weather didn't turn up that way. So we left with higher merchandise this year. And so we have to go for early discounting and heavy discounting, because being a third quarter is very heavy for us, as 50-55% contribution from that. So because of that, we have to go for higher discounts, and that has resulted in around 25 CR of extra discount, which we gave in that quarter. And also we have to take extra return of round, which impacted 45 CR to our profitability. But I think the worst is behind us. Going forward, we'll be seeing, as far as profitability is concerned, we'll definitely see higher profitability from this level.
All right. I remember this very clearly, Sandeep. I remember speaking to you in February itself, and you said that you were hit by a bit of a double whammy, because in December, when there was no winter, you sold the products at a discount, and when Jan it started to get cold, your stores were running out of inventory because of the sale that you had done in December already. So, all said and done, what are you looking at in terms of growth for this year? Because weather is so volatile, it's also extremely hot right now. You are increasing your contribution coming in from non-winter products as well. So what's the strategy for this year and the next? What's the targeted growth?
See, to be very honest, this year we are, guiding a very flat revenue this year. We're not anticipating any growth in this financial year. But the more focus is on the profitability, because we know that there are some areas where we lost because of higher discounting in some of the EBOs and other channels. So some of the channels we are shutting it down, and some of the EBOs we are shutting it down, and we are adding another around 40 to 45 EBOs, which will compensate the sales of these EBOs, but that will result in more profits. At the same time, we have increased our prices around 7 to 8% in the summer as well as in winters. So I'm 100% sure that we'll be having a very good profitability as compared to last year's level. But the revenue, we say that will be having a flat year going ahead. But we can come back and revise our guidance in second quarter, because even till today, the consumption is not going up. Consumption is still very, very weak. Discretionary spending is not happening. Maybe after the election, if something government comes up with something and economy rebounds, definitely we can come back with revised guidance.
When you spoke about profitability improving, what's the sort of margin that you're targeting this year? Because, that's had an impact, these sales, etc. Your fourth quarter EBITDA turned into a loss. What's the kind of margin that you're targeting?
Yeah, so I can't say you exact margins, but the last year we used to maintain a EBITDA of around 20% from last 10, 15 years. But last year it went down to 15%. But definitely there will be a significant jump from the last year's margin. But actual EBITDA margin, I can only guide you in the month of September and October. That is second quarter phone call.
Okay, so since you're saying that demand is weak, right, and your losses are piling up as well, would you go slow on capex plans? Any major capex that you have for FY25?
No, we have a normal capex of around 15 CR, which is a normal capex. But yes, there will be addition of EBOs, but most of them are franchise operated, so there's no capex involved.
Okay, there's no capex involved. Got that. Also wanted to understand in your kids segment, right, the volumes have declined quite a bit. So in FY25, any kind of recovery that you're looking at over there?
We see a flat growth in kids also. I think we achieved 90 to 90 CR of kids wear sales, and we hope to have it at this level only.
All right. And what about Rocket and Luxuria? Rocket, what has it reached right now? What's the scalability there? And Luxuria also, the premium products are doing well everywhere.
Yeah, Rocket has performed well, and we saw a significant jump of revenue from 9 CR to around 28 CR. And Luxuria also, being a premium category, it's around 40 to 50% higher prices than Monte Carlo, and we see a turnover going from 9 CR to again 35 CR. So these two segments have performed very good for us. At the same time, home furnishing, that also contributed good, and we anticipate good growth going forward in home furnishing as well.
So what's your target from Rocket, Luxuria and home furnishings in the next 1 to 3 years? Because they're growing extremely fast, they could lead the next leg of growth. You have any aspirational number here?
Yeah, the base is small, so we're targeting around 20 to 25% of growth from these categories.
Okay, all right. We'll let you go on that note, Sandeep. Thanks a lot for joining in. Appreciate your time here on CNBC-TV18. Let's take a quick break. On the other side, full tilt on the markets. Pritesh Mehta of Yes Securities will join in with some trading strategies. Stay tuned.
Welcome back. The Nifty still lower, holding above 22,700, and that's a big positive. Apart from that, we have the mid-cap index, which is not falling as much. That's another positive. The Nifty Bank is lower too. But what's interesting is that it's Nifty Bank monthly options expiry today. So if you just take a look at the FNO setup, the good part is that there has been a fair amount of put writing at the 48,500 mark for the Nifty Bank. So that's an important support to watch out for in the second half of trade in particular. On the way up, the 48,700 call is equally active. So if we do see a recovery, sustaining above 48,750 would be extremely crucial for the Nifty Bank to see further short covering. But until then, it's this range of 48,500 at the lower level to around 48,800 on the way up for the Nifty Bank itself. For the Nifty as well, the put writers are pretty active at 22,750, and this is a put which is in the money. And on the way up, 22,800 call is equally active, telling you again 22,650 to 22,900 is the sort of range that the street is working with for tomorrow, which is the Nifty expiry, the monthly expiry that plays out as well. Despite the cut that we've seen, what tells you about the ferocity of the rally is that we're still a distance away from the 20-day moving average, which is the most recent moving average on both the Nifty Bank as well as the Nifty. So there is no cause for worry, so to say, for the frontline indices. It's just volatility, and that's reflected in the India VIX as well, which, over the last few trading sessions has spiked back once again to levels of around 24.5, which is a near 2-year high. So that's something we'll keep an eye out on ahead of the big events that we are watching out for. Individual stocks, they're all in focus. GMR Infra may enter F&O ban one day ahead of expiry, and Piramal Enterprises may exit F&O ban. So those are a couple of stocks which are on my radar.
Okay, well, that is in the F&O space, right? And that's a view on, that is the update on the market. Pritesh Mehta of Yes Securities is joining in to give us a view on the market as well. Pritesh, it's the bank Nifty that's coming under some pressure. So it was almost getting set to hit that 50,000 mark, and then we came off from there. But be that as it may, do you think that this is just election-related jitters? And if yes, what should one be doing now?
See, good afternoon, first of all. Sometimes doing nothing is the best thing to do in the highly uncertain environment, especially when it comes to trading index, that is both Nifty and Bank Nifty. See, our customized breadth of Nifty has given a bearish crossover. We have seen a confirmation of price coming down, breadth tilting lower from the over optimism zone. In this kind of environment, we can see a bit of pullback, a bit of retracement. At this moment, I'm not expecting a bit movement downside. In fact, I'm not expecting any movement on either side. In fact, index could come lower to 22,600 levels. So in this kind of market, at 100 points move is nothing much to talk about. So I think doing nothing on the index is the right way to approach this market.
Right, doing nothing, that's actually the best thing to do a lot of times, not just in the market, in life as well. But a lot of individual stocks are doing extremely well from the broader markets. We're seeing some uptick in names like United Breweries, which has moved to the high point of trade. Vedanta continues to do well. All these Birla Group stocks, Aditya Birla Fashion, we just spoke about at the start of the show, has recovered 6.5% from lows. So what do you have on your stock side? Are there more buys, or there are shorting opportunities as well?
See, broader markets is a completely different space altogether. Despite the volatility we have seen in Bank Nifty and Nifty, broader markets are doing well. Whether you look at Nifty small cap, mid cap, or even Nifty micro cap index, they are doing relatively better. So, stocks from this space, I think we need to chase them. We need to look after them. So when you were mentioning about the Birla Group stocks, ABFRL looks very interesting. The stock has made a strong recovery last couple of weeks. And the way the structure is shaping up, we are witnessing, a double top buy, series of double top buy coming in on this particular stock. So we can see a rally towards 335, and the stock would be around somewhere around 283. And second stock that we like is Coromandel Fertilizer, Coromandel International, in fact. So basically, the stock has given a breakout of a 45-degree downslope trend line on point of figure chart, and they are witnessing follow-through moves on the upside. So the targets are seen around 1350 levels. And the stop loss would be around 1230 levels.
Okay, well, all right. I also wanted your thoughts on some of these other PSU names, right, that have been rallying quite a bit. So there is Nalco, there's Hoodco, there's NBCC. A lot of PSU banks are doing well. PNB, there's BEL, Defense is doing well. From the entire PSU universe, anything else where you see more traction once this volatility settles?
See, we need to understand, need to look at the ratio of the PSU bank versus private bank, and that ratio is inching higher. It's on the verge of surpassing the previous peak that we had seen a couple of years back. So when that confirmation comes into play, it would tell us that PSU banks are going to outperform the private banks. So this one thing could play out maybe once the volatility settles down. Second thing is that when you look at since we are talking about the PSU basket, we need to keep into consideration the oil and gas energy space. So when you talk about the energy space, OMCs come to my mind, something like BPCL, HPCL, good basing pattern breakout are taking place in that particular basket. So 15-20% move is possible in these stocks, maybe for next 2-3 months.
All right. And finally, before we let you go, Pritesh, a word on some of these consumer names. We have, Trent, which has moved higher. ABFRL, of course, you said you liked. And the other one is we're looking at some uptick in Jubilant Foodworks. In fact, in the last 4 or 5 trading sessions, the stock is up 10%. Has it made a buy list yet?
It has. In fact, on short-term charts, the stock has rallied a lot. We are talking about rally from 450 levels to 513 levels. So from risk-reward perspective, it wouldn't be the right way to approach the stock right now. Maybe once the stock comes back to levels of 490, it would give it a right risk-reward ratio to go for long on this counter.
Okay, all right. Thank you for that. Well, the market is still under pressure, by the way. It's almost 0.8% downtick that we're seeing on the Sensex right now. It's nothing alarming, to be honest. For now, at least it's holding. The Nifty is holding on to the 22,700 mark. But you don't know which way it could go as we get closer to the exit poll results on Saturday night. But here's a quick note for our viewers. A daily wrap of all the top headlines will hit your inbox before you call it a night, with CNBC TV18's daily newsletter on LinkedIn featuring the top 10 stories on markets, corporate updates, economic insights and financial highlights. So subscribe now and get the CNBC TV18 edge.
Welcome back. The Nifty holding around that 22,750 mark, cut of almost 150 points. Let's talk about some of the numbers that came by. We have spoken with a couple of managements. Let's put focus now on APJ Surendra Park, which basically well known as the brands that it runs, Park Hotels. And we have, 30 hotels that the company runs in 20 cities. Reported a good set of numbers, as we've seen for a lot of the hospitality companies this time around as well, an 8% revenue growth, relating actually moving to a 34% EBITDA margin with a net profit growth of 72% as well. We have with us the management, Vijay Devan, who's the MD of the company, joining in. Vijay, while we have the reported numbers, we don't have a couple of these internals. Could you give us a sense of what the occupancy in the fourth quarter was and what the ARRs were?
So firstly, thank you for inviting me, and I'm delighted to be here. We have had an exceptional quarter, and we have had an exceptional year which has gone by. In terms of our yearly performance, our revenues have grown by 13%, EBITDA has grown by 16%. And the most significant thing is that our PAT percentage has grown by 43%. We have market leadership in occupancy. In fact, we have India's leading occupancy of 92% year-round. And we have also achieved excellent results in terms of RevPAR and ARR. We are market leaders in RevPAR in the segment in which we operate, that is in the upper upscale segment. And we have had 11% growth on the ARR front as well. The other very significant part of the business model of Park is that it has a very strong focus on the F&B side of the business, where the contribution of F&B to the total business is 42%. And the success of the F&B adds a non-cyclical element to our business and provides for a lot of strength to our business.
So in terms of geographic expansion, I just want to understand, most of your business still comes from West Bengal and Hyderabad, right, Mr. Surendra? Any other plans that you have to expand into different geographies? Sorry, Mr. Devan?
Yes, so currently, during the course of this financial year, we have added 374 keys to our portfolio across 8 hotels. We plan to add another 234 keys across 6 hotels in the coming year. 2 of these are going to be palace hotels, adding 52 rooms. One is going to be the Ranbas Palace, which is on Kila Mubarak of the former Maharaja of Patiala, which is going to add 37 rooms. And the second is going to be the Chettinad Palace in Chettinad. These 2 are palace hotels. These are significantly going to add to our revenues, to our average revenues going forward. More significantly, during the course of this year, we are going to take up 3 development projects. A 200-room project starts in Pune in the month of September. We are starting our project extension at Visakhapatnam, 100 rooms. And most importantly, we are going to start a mega project on EM Bypass in Calcutta, which is 250 rooms and 100 service apartments. These service apartments are going to be sold by us, and through the sale proceeds, what's going to happen that it's going to add about 100 crores of cash flow starting next year into our balance sheet over the next 3 years. We are currently also net cash positive. There's no debt on the company. So very, very strong balance sheet and poised for significant growth going forward.
Right. So, all these points are well taken on board, and some of them you had spoken about when you had come in for the IPO as well. Mr. Devan, I just wanted a couple of points here. One, the entire year you did pay a finance cost of over 60 crores. So I wanted to know whether entirely that would be eroded in the next year given your debt-free status now. That's point number one. And secondly, during the IPO, we had asked Ms. Paul, can we expect 60 to 70 crore profits in FY24 and 120 to 130 crores profits in FY25 because of this finance cost element and the expansion going out? She said that's about right. And for this year, you did a PAT of around 69 crores. So should we hold on to that 120 to 130 crore profitability in FY25 for you?
So firstly, as I mentioned, and as Ms. Paul mentioned, that we will cross the 60 crores in terms of PAT. In fact, we have delivered 69 crores, which is a 43% improvement over the previous year. To answer your question in terms of the 60 crores interest cost, yes, the debt has been fully retired within 7 days of the IPO. And this should get added on to the result in the coming year.
And the net profit, because of the 60 crore going out, immediately doubles already. So 120 to 130 crores is on the cards for FY25, right?
It should grow in a very significant manner. We will have to keep in mind that there would be a tax calculation. But with the growth trajectory which we have, it looks that these numbers would be achieved or even surpassed.
Okay. The F&B contribution you said for the company is at about 42%, correct? So I just want to understand how much can you grow that to over the next 1 to 2 years? And also on the mice business, I want to understand where are we at currently? What's the contribution and how much can you grow that?
So firstly, as far as the F&B business is concerned, we are not only running the F&B business within our hotels, we are also there in the F&B service space through our brand Flurys at the moment in West Bengal as well as in Maharashtra. Currently, we are operating 82 outlets of Flurys. Flurys is a heritage brand out of Calcutta and is known for its confections, its coffee and celebration. So it's a celebration brand. We have 82 outlets at the moment. We plan to take it to about 100 outlets by the end of H1 and then take it to 120 outlets by the end of this financial year. And going forward, we have a very strong plan of adding 50 outlets of Flurys virtually every year to take it to 350 outlets over the next 4 to 5 years. What is significant about the Flurys brand is that it is going to add, it provides for a very strong growth. The previous year, which has gone by, we have had a growth in the Flurys business by approximately 25%. And Flurys provides for industry-leading margins of 18%. And this trajectory, again, is going to continues. And this actually is responsible for the growth of our food and beverage business. On the other side, we are very successful in running our events and entertainment business in our hotel. We strongly believe that you see customer value gets added because of entertainment. So entertainment in our hotels is used to create value. And some of our nightclubs and bars are exceedingly successful. So we have decided to take one of our brands outside the hotel space. We have launched someplace else which is our successful bar brand in Mumbai in the Geo World Mart mall, and it has been exceedingly successful. Going forward, see that there is going to be further expansion in the beverage side of the business on a standalone basis. This business also in India is also growing at a very fast rate of about 20 to 22%. So we are there.
Take that point.
Yeah.
Yeah, Mr. Diwan, running short on time, but both Sonia and I, we have visited the someplace else in Mumbai itself, and also I have roots from Calcutta, so Fleury is an iconic brand. Happy to know that it's going to go to 120 places now from 82 outlets, and at the same time 50 more being added would definitely like some more outlets in the city of Mumbai. I vouch for their breads.
Yeah,
Incredible
absolutely.
breads. Yeah,
Iconic, right? Even someplace else. It's a fun place.
It's a fun place.
Before we
Thank you for joining in. Yeah, please go ahead.
I must say that we have opened 2 outlets of Fleury's at the Mumbai airport in the in the Terminal 2, and we are going to be soon at the gateway of Mumbai, as well as on the Colaba Causeway during the month of June.
Perfect. I could do with one in Colaba. The airport is a little further from my house, not as much from Sonia's. We'll take your leave on that note and wish you good luck for all your expansion plans that you have. On the other side, we'll come back and we'll talk about another company which is seeing its share price expand. That's Campus Activewear, reacting strongly to its fourth quarter numbers. Welcome back. One of the stocks of the day have to be Campus Activewear, up around 17%. And as we speak, that's on account of their numbers. The reason why that has happened is because even as the company's revenues have grown just around 4.6%, it's led by about 4% volume growth, a mild improvement over the last few quarters where we've seen revenues, struggle for the company. And that has led to an improvement in their margins from 16.3%. They've gone all the way up to 17.6%. And the net profit as a result of which has also grown 40%. What's important is that, the company said that a large part of this revenue growth in the second quarter or the second half of this year has come by on account of their focus on trade distribution. Add to that, they've also seen some improvement in their balance sheet. They've gone ahead and repaid debt worth nearly 156 odd crores, and the company has become debt-free in the financial year FY24. And add to that, they've also reduced their working capital days from a little over 100 to a little under 70. So all these factors working well for them. We had a Kotak note coming in this morning from on Campus Activewear. They have said that it's a good beat on profitability in particular, while they have an ad rating and a target price of 285 on the stock. Mind you, from its record high, the stock has seen a correction of over 40% despite this up move that we've seen. So let's see where this goes from here. A 4% volume growth that they've reported is good, but the management guides for double-digit revenue growth going forward, along with margins in this band of 17 to 19%. So good numbers on track. Let's see whether glory days for Campus come by or not at current reckoning too. But before we slip into a short break, just also keep an eye out on the Nifty, the HDFC Bank stock. Remember last week, the stock had conquered all its moving averages, including the 200-day moving average. But now as we speak at 1508, it's about 7 rupees below its 200-day moving average. So if you can just, pull up the chart which has both the 50 and the 200-day moving averages of HDFC Bank, you would see that in today's trading session, the 200-day moving average of HDFC Bank has been breached on the way down. So that's the one that we have to keep an eye out on. The line in orange is actually the 200-day moving average, and we have seen the stock below that. The line in blue is the 50-day moving average, so should hold as an important support around that 1485 mark. Take a short break, come back on the other side. Manisha Gupta, as always, joins in with all things commodities.
Welcome back, and joining us on the show now is Kunal Shah. He's head of commodities and currencies at Nirmal Bang. Kunal, hi, thank you so much for joining us. And it's a day when silver is hitting all-time highs in the Indian markets right now. So while the international markets continue to hold around that 11-year highs, it is the Indian prices which have seen this surge coming not too far away now from ₹1,00,000 a kg. When do you see that level now coming in?
And in the history of the financial market, for the first time, we have seen with the US interest rate at 5.5%, we are seeing all commodities and including silver now hitting an all-time high. So if you see what has been happening, silver is having a deficit of almost 12% from last 3 years. Second, the scrap sales are not coming the way they should have been coming in the market at this price. And there is no incremental growth in the supply from last 5 to 6 years. So it is in a very strong bull run. There is no doubt about it. And yes, very likely it may test 1 lakh rupees in a matter of few days or a week. So the outlook continues to remain bullish on silver. These are the levels, if you bought silver at 60,000 rupees or 70,000 rupees, then my advice would be for the traders or for the short-term investors, they can book profits. But the long-term outlook, I don't see, in spite of the fact that prices have risen so much, no major supply side growth is going to come in a shorter term. Maybe 1.5, 2 years down the line, with the prices remaining at these levels, we may see a lot of mines may restart and exploration may start. But at this point, it doesn't look that this bull run is going to be abated. And the likelihood of it going to $33.5 looks very likely.
Kunal, while a lakh of rupees is quite a given right now, I mean, as you said, it could happen in matter of days and weeks now. But on the higher side, where do you see any kind of a resistance coming in for silver? I mean, as you mentioned, the fundamentals are all on the stronger side. So in the international markets, for the Indian markets now, if we are looking at further spikes within this year, because the industrial demand will come in, we will see rate cuts, even if a few, but at some point in time in this year, what is on the higher side of sense now?
Yes, Manisha, exactly. The market is basically priced in. So whoever has been the investing community across the globe, they have taken one thing, that no matter interest rates are at a higher level or no matter what, but the monetary conditions going forward are going to be relaxed. That is the consensus across the world, because the Western central banks cannot afford to service their debt after a point with the higher interest rate and with the higher bond yield. So in spite of the fact that interest rate cuts have not taken place, you've seen a massive rally across all commodities, and all commodities is basically the rally behind. It is coming at a time when world wants inflation to goes down and China is opening up. China is coming up with more and more packages, more and more incentive to revive their real estate market. And at a time when commodity prices should have remained stable at that time, relax monetary condition, expectation of relaxed monetary condition, and China again growing, expectation of China growing high. A lot of agencies are coming up with a higher growth forecast for China. So these two things are coming at a point where world wanted commodity to remain stable. And unfortunately, I believe that the inflation is not going to come down in the developed part of the world. It is going to go up. And we will have to live with the higher inflation going forward. So rate cuts are imminent, just a matter of time. And the fundamental of commodities, silver, continues to remain positive.
Well, that's about the precious metal prices, Kunal. But when you look at the industrial metals, we've seen a stellar April. May is only built up on that. And we've seen higher highs in many of these industrial commodities. So whether it's about copper, aluminum, zinc, we've done quite well on the charts and in sense of month-on-month return as well. From here on, for the month of June, now, would you look at consolidation at these current levels, or are you looking at further higher highs?
For the further higher highs, we require some clarity on when the rate cuts are coming. So now another trigger for metals to move up will be the trigger for the rate cut. So maybe tomorrow we have a US GDP numbers and you see a drop in US GDP, or you see a key data from US indicating that the US economy is softening. I think metals will again start to rally. So the downside seems to be very limited at this point. Upside, already we have seen a humongous upside when it comes to some of the metals like copper or, for example, zinc, 20% rally what we have seen in copper. So at this point, my recommendation is buy the dips whenever any data, anything which comes negative for base metals and you see a dip in that time you enter. So copper around 870, 880, good levels to re-enter. Again, it can surprise you on the upside to 935, 940 on MCX. Again, around $10,800, $10,700 on LME. But the broader trend for the base metal seems buy at dips, considering the expectation of easy monetary policy from the US, in spite of the higher inflation rate. And second, China really trying to grow up and trying to give momentum to its economy at a time when world want commodity price to remain soft.
All right, you're speaking about commodities, and as we speak, it is actually the commodity stocks which have seen a bit of a spike, Manisha. Thanks for joining in, and Kunal, for that conversation. The Nifty Metals Index should come up for you. That's moved to the high point of trade, and as a result of which we've seen the Nifty ameliorate some of the losses as well. When we started the show, the Nifty was closer to that 22,700 mark, and now it's closer to the 22,760 mark, and that's led entirely by the metal space. Of course, a big mover in that has to be Hindalco. Started off slow and steady as the street was believing that maybe there could be some supply after the big rally that we've seen ahead of the news of the Novelis IPO, but now the street seems to be waking up to the valuation potential out there, and as a result of which there's a big up move that we've seen on Hindalco itself. Take a short break, come back. On the other side, we have Business Lunch taking all the market action ahead for you.